You should never buy individual stocks, and in this video I'll tell you why. And if you think I'm just gonna spout out tired reasoning like 80% of money managers in actively managed funds can't beat a simple S&P 500 index, well then, stay with me. Because while those stats are true, that's not the reason I think you shouldn't be buying individual stocks. The main reason I think you shouldn't be buying individual stocks is, how do you even know if you're good at picking stocks? That may sound a bit abstract, but stay with me for a minute. When you start playing a sport, or a musical instrument, true talent almost always shines through right away. Tiger Woods was great at golf at 3 years old. Everyone knew LeBron James was going to be the best basketball player on the planet before he was even old enough to vote. But that's just not true in the stock market. The stock market involves a high amount of variance. I like to think of it kind of like a game of poker. The worst, most talentless poker players you have ever seen can go on some insane winning streaks through sheer luck.
How do these players even last?
Jack high.
Just as the best and most talented players can go on extended losing streaks. But over a long enough period of time, a long enough sample size, the effect of luck on the results diminishes, and the most skillful players will be the ones holding all the money.
What are they, the luckiest guys in Las Vegas?
But how long does it take in the stock market to figure out if you're a good stock picker? Is it days, months, years? It's easy to say that Warren Buffett is a great stock picker because he has 70 years of success to prove it. But what about someone like Cathie Wood? In 2020 and 2021, she was the queen of Wall Street, with her ARK Invest ETFs crushing the market and providing insane returns. But in 2022 and 23, she's become a bit of a laughingstock, as her funds have dramatically crashed and are now severely lagging the market. What about someone like Jim Cramer? Well, okay, we know the answer to that one. The truth is, it likely takes years, maybe even decades, to prove out that you're a good stock picker. And even if you do turn out to be above average and show a profit from trading over the long run, it's still likely you're going to lag an index like the S&P 500. Those 80% of fund managers we mentioned earlier, they're not unprofitable. They make their investors money. It's just that the returns they're providing aren't as good as holding a simple S&P 500 index fund. The main takeaway from this argument is that in many ways, investing is a race against time. We only have so many years available to us to accumulate the amount of money we need to reach our end goals. And it would really suck to waste years of our investing lives and lose how many thousands of dollars along the way, only to learn we don't have the skills to outperform a simple buy and hold index fund strategy. But beyond that, there are still a whole host of reasons why you shouldn't buy individual stocks. Do you have the emotional makeup to be a good stock picker? Amazon and Apple are two of the greatest success stories in the stock market over the last 30 years. But there was a point in time where Amazon stock lost 90% of its value, and Apple's stock went years and years returning nothing to investors. Would you have stuck it out to realize the insane gains that were coming down the line? Or would you have just cut your losses and moved on to something else? If you're investing in Facebook, Meta stock right now, are all the recent losses just a bump in the road? A sign that you should double down on your bet while they change strategies and it pays off in the end? Or is it simply a doomed company going all in on a long shot strategy that will never pan out? Unless you own a DeLorean, that's probably a near impossible question to answer. And these near impossible to answer questions happen all the time when you're investing in individual companies. And to be a successful stock investor and to be a successful stock picker, you have to answer them right more often than not. And most people can't accurately answer these questions because of the skill thing we talked about earlier, and because stock picking is hard work and requires a lot of attention. Be honest with yourself. Are you really analyzing financial statements, listening to earnings calls, and keeping up to date with all the news on all the stocks you own? It's okay, you can tell me. This is just an honest conversation between friends here. Or are you just putting money into stocks that you think are gonna go up because of reasons? That's why for the majority of us, I think index fund investing is the way to go. I know. Index funds may seem like boring investments that never change, but that's actually not true. Index funds are a lot more active than most investors realize. An S&P 500 index fund is one of the most popular index funds out there, and the S&P 500 index is kind of the default benchmark that every investor measures their performance against. But did you realize that the makeup of the S&P 500 index changes by about 4.5% every year? That's 22 companies added or subtracted every year. Standard & Poor's, the S&P of S&P 500, have a whole committee that decides which companies are included and dropped from the index in any given year. They have a set of criteria we use, and sometimes it goes down to a debate, as we saw in 2021 when Tesla was finally included in the S&P 500 index, replacing the Apartment and Investment Management REIT. But it's not just companies being added and dropped that make up all the ways an index fund like the S&P 500 will change. About 20 years ago, in 2002, the top 10 stocks of the S&P 500 were Microsoft, GE, Exxon, Walmart, Pfizer, Citigroup, AIG, IBM, Intel, and Cisco. All strong companies, well-known names that you as an individual stock picker may have been content to hold and never change. But fast forward to today, and the S&P 500 index looks radically different. Now it's Apple, Microsoft, Amazon, Tesla, Google, Berkshire Hathaway, United Health Group, Johnson & Johnson, and Nvidia. The S&P 500 index changes because it's an index that tends to reflect and represent the overall shape and health of the US economy. And that's why it produces those returns that are so hard to beat. So why would you want to spend so much time and energy on something where the skill is so hard to measure in the first place, and it takes so long to uncover whether you actually have that skill to begin with? And for a lot of people, it's because they've simply been misled into thinking, well, that's what investing means. That's what I gotta do to be an investor. And that's simply not the case. Good investing is simple investing. Good investing frees up your time and energy for other things in your life. That's why about 95% of my money is invested in a simple buy and hold index fund strategy like I outlined in that video right there. Check that out next. Start investing smarter, and thanks for watching. I'll see you next time.